Alright, guys, so let's talk about the big time bomb in the US today. When it comes to a recession, everyone knows that it normally starts with the banking system. It's the first thing to break. Now, this Jenga economy is built on credit and loans. If the banks stop giving Main Street money, the entire US will grind to a halt. And by extension, the global economy will crash as well. And for 2 years, the banks have been hiding tremendous losses on their books. Ever since interest rates started to rise, a ton of their assets went underwater. And this is one big ticking time bomb. If these losses manifest, it could very well trigger another SVB crisis. More regional banks could go under, and this revolves around commercial real estate today. Unrealized losses hit an incredible $516 billion in Q1. This is an increase of 8.2% from the previous quarter in Q4. The big question is if this pile of losses will blow up and trigger a recession. We know the Federal Reserve is going to cut interest rates. By December, we could see rates drop from 5.5% down to under 5. If that happens, it should technically reduce pressure on the banks, right? The biggest threat facing them is loan defaults, and by far the biggest threat to the system is CREs, especially office spaces. If all the landlords continue to bleed money, they'll be forced to throw their keys back to the bank. And we are coming close to the risk of massive foreclosures. High interest rates, they have done their damage, and just in office spaces alone, the buildings lost an incredible 557 drop in value between 2019 and 2023. And that's not even counting in January to August this year. We call this the final chapter of the crisis because this will either lead to a crash or it'll just fizzle out as property values eventually recover. Now, can the banks really win this extend and pretend game when it comes to their underwater loans? That is the big question.
This is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration.
Now, Jerome Powell believes everything is hunky dory, but we are beginning to see big signs that the system is starting to crack. The issue here is plunging office values. Many office buildings are starting to sell for much lower prices than just 3 or 4 years ago. And if prices collapse enough, we could see property owners default on their debt. Blackstone, for example, bought an office building in 2014 for $605 million. Today, the building was bought for less than $200 million, and that's a drop of over 50 or 60% easily. And it gets worse for other office spaces across the country. A historic office building sold for $16 million this year, down from $72 million in just 2018. West Adam Street was bought for only $4 million. The original price was $51 million 12 years back. We are talking about an 80 to 90% wipeout. If you are the owner and you borrowed money to finance the purchase, well, you are deeply underwater. Your decision is going to affect the banking sector and by extension the entire US economy. Do you take the hit now and liquidate for cash? Or do you hang on and you hope and pray for things to turn? Because you are betting on two things to shift, and they must happen or else you are finished. Now, firstly, rates have to come down meaningfully, which means massive rate cuts. A mini 25-point cut won't cut it. Rates have to drop hard and they have to drop fast. And this will allow office owners to rush and refinance their mortgages. They need to reduce their financial bleeding from a 7% rate down to 5 or even 4%. And the Federal Reserve, they will have to act fast. There's a big wall of CRE mortgage maturities coming. Nearly $5 trillion are tied up on commercial real estate loans. And here's the problem. In 2024, at least $650 billion worth of loans will be maturing, of which $210 billion belongs to office buildings. If rates don't come crashing down, we could see more property owners throw their keys back to the bank. And if they decide to eat the loss, the banks will be the big bag holders. Now they're holding a ton of hot potatoes they need to sell that no one else wants to buy. In other words, a major fire sale could be on the way. And that's how precarious the situation is. It's key to highlight that 2024 and 2025 will be the final milestones for this CRE threat. If we manage to get past this period without an implosion, then we are most likely in the clear. According to the CBRE, this year and next year will have the most amount of loans maturing, nearly a trillion this year, of which $210 billion is from offices. In 2025, the exposure is around 600 billion. The biggest defaults will come during this period because interest rates will be at their highest, likely near 5% this year and maybe 3 to 4% next year. If property owners all decide to refinance their loans, and if the banks are willing to extend and pretend once again, this house of cards probably won't fall. The banks probably have no choice but to play ball because they are horribly exposed. This is a chart of the biggest US banks and their total exposure to CRE loans. Almost 13% of JP Morgan's loans comes from CREs, 21% for Wells Fargo and 4% for Citigroup. The big concern is the smaller entities on the list. They have loan exposures of 20 to 40% in CREs. If the loans default, they could be underwater and will have another wave of banking consolidations. The big boys, they'll just eat up the smaller banks, just like how JP Morgan acquired First Republic in May last year. The mega banks will become even bigger down the road. Now, when banks consolidate and when things blow up, this will affect how credit flows into the economy. Obviously, the banks will become more frightened and extending loans across the US will get harder. This could affect small businesses in the US and personal loans as well. So we could be in a very weird situation. Short-term rates could fall because of the Fed rate cuts, but loans out there in the real economy could stay very expensive because of this banking risk. Now, the fear of further defaults could grind credit to a halt, and this would most definitely affect the real economy out there. The key is to watch carefully for reports of plunging office prices, and they will be the canary in the coal mine. If the bad news keeps piling up, this could really trigger a wave of CRE defaults. Now, rates coming down is just one part of the equation. Owners also need to ensure their income doesn't collapse. And this means office owners need to lease their spaces out there and rents have to increase. But the story isn't great on this front either. In 2019, office vacancy rates were around 10 to 12%. But look at vacancies across the major US cities. It's between 15 to 20%. In the Bay Area, it's 21%. In Austin, Texas, vacancies hit nearly 23%. Companies are scaling back and they are renting less. And this translates to a drop in revenue for office building owners. They now have less money to pay their mortgages, and some could be losing millions of dollars every single month. And this really begs a big question. Why are companies renting less? Obviously, it's because business is slowing down and layoffs are happening. So there's less need for bigger office spaces, and you don't really need a degree from Harvard to figure this out. Simple cause and effect. The big question now is, will the US economy continue chugging along? We just had a massive payroll revision down. I think we can all remember that. Minus 818,000 jobs. Unemployment is also starting to trend up. We are now at 4.3% in July, the highest reading since 2021. And if a recession strikes, the unemployment rate can go from 4.3% to double digits in a flash. 2020 was extreme, but something similar happened back in '08 as well. And that's why office vacancies and the CRE crisis are very good indicators of the economy. When you let go of workers, you cut away your office space as well to save money. It's a sign of a weakening economy. Now, there are a lot of conflicting signals out there, especially from the official reports, and it's really up to you if you believe them or not. I personally have some skepticism here. Just yesterday, the GDP report was revised up. It seems the US economy expanded at a 3% rate now. Consumers are still resilient, so spending is staying strong. At least that's what they claim. Consumer spending was revised upwards to 2.9% from a previous reading of 2.3%. But if that's the case, why is unemployment trending up and payrolls collapsing? Why are office vacancies increasing? So there's a big disconnect between the data you need to be very aware of. Now, what's really concerning are reports from the stores themselves. According to many grocery chains and discount stores, the US consumer is tapped out. Dollar General is warning that poorer US consumers are running out of money. Their operating profit fell by incredible 20% even though sales are up by over 4%. So something is obviously wrong with the economy. Things are weaker under the surface than what's being reported on the headline numbers. Households earning less than 35 grand are feeling financially constrained. The majority feel worse off today than they were 6 months ago. The pain is starting to add up and even dollar stores are getting hammered. It's really important we keep an eye out on the last leg of the economy, which is the consumer. If they buckle, this could really cascade and trigger a CRE crisis, and that in turn would squeeze credit away from the banks. Loans could suddenly dry up even though rates are coming down. Now, can a bailout happen? Is a bailout coming? Well, the US government can always spend their way out. Let's not forget that. Just fire up the printing machine and issue a mountain of bonds. And if they borrow trillions more, sure, they can avoid a CRE collapse. But we could see a bigger inflation down the road. There's really no free lunch in any economy, even if it's the US. But as always, let me know what you think. Can the Federal Reserve stop a crisis? Or are interest rate cuts just not enough to save the system? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.